Okay, let's unpack this. For years, investors have, well, leaned on U.S. long-term Treasury bonds as the ultimate safe haven. They're the traditional anchor, right? The counterweight to those volatile stock markets. But our sources for this deep dive suggest that conventional wisdom is now, well, maybe a mirage. What if the very bedrock of safe investing is shifting, like fundamentally, beneath our feet?
What's truly fascinating in our source material is this argument for a fundamental paradigm shift, a big one. We're looking at a situation where the traditional formula for bond investing isn't just taking a temporary hit. It seems to be breaking down structurally. And it appears to be driven by a potent, almost toxic combination of three powerful factors. And here's the kicker. Even the anticipated interest rate cuts from the Federal Reserve might not offer the relief investors expect. In fact, our sources suggest they could inadvertently make things worse.
Worse. Wow. So, what does this all mean for you? Whether you're an investor or maybe just someone trying to stay well informed. We're going to dive into the specific evidence that paints a very different picture of bond safety. Our mission today is really to challenge those long-held assumptions. We'll explore these three critical pillars. First, the unsustainable path of government debt. Second, a challenging and persistent stagflationary economic environment. And third, some unsettling yet incredibly relevant historical precedents. Okay, let's jump right into the big conversation everyone seems to be having, the Federal Reserve and those eagerly anticipated interest rate cuts. The market is absolutely fixated on Fed easing, and, well, you can see why. The U.S. labor market is clearly slowing down. That August 2025 non-farm payroll report, for example, it showed a meager 22,000 new jobs, and those massive downward revisions to previous job creation figures. Oof, even Fed Chair Jerome Powell has explicitly acknowledged downside risks to employment. Yeah. That certainly sounds like a green light for lower rates, which usually means good news for bonds, right?
It is the classic, almost Pavlovian market response, isn't it? Fed cuts rates, bond yields fall, bond prices rise. Simple. But here's where we need to look closer as our sources really dig into. That traditional relationship relies on two crucial conditions: controlled inflation and stable fiscal policy. And our sources make it pretty clear that neither of those conditions is currently being met. Not really. This raises an important question, and it's central to this deep dive. Why aren't these rate cuts the green light investors typically expect? Because, long-term bond yields are about more than just short-term policy rates. They're also heavily influenced by future rate expectations, and crucially, something called the term premium.
Right. You mentioned the term premium, and our sources really emphasize how critical, yet often overlooked, this factor is today. For those who might not be familiar, could you quickly explain what the term premium is and maybe why our sources are highlighting its sort of increasing dominance in determining long-term rates?
Absolutely. The term premium is essentially the additional compensation investors demand for holding a long-term bond compared to, say, rolling over short-term bonds for the same period. It's their way of pricing in future risks like unexpected inflation or interest rate volatility over that longer horizon. What's fascinating here, and the Fed's own analysis points this out, is that the significant rise in 10-year Treasury yields back in late 2023 and early 2025. That was primarily driven by an expansion of this term premium, not just shifts in short-term policy rate expectations. And there are these powerful structural forces pushing it higher, things like vast, ongoing government bond supply, future inflation uncertainty stemming from sticky service prices and new tariffs, and these growing concerns about the U.S.'s long-term fiscal path. All of this effectively embeds a kind of fiscal risk premium into those long-term rates.
Okay, this sounds completely counterintuitive, I have to say. But our sources suggest that in this unique environment, a Fed rate cut, typically seen as a positive for bonds, could actually be bad for long-term treasuries. How does that surprising dynamic work? It feels upside down.
Well, the logic laid out is quite sobering, actually. Imagine the Fed cuts rates because the labor market shows weakness, like we just discussed. But the critical point is that inflation remains stubbornly above target, still sticky. When the Fed eases in this environment, it sends a signal, maybe unintentionally, to the market. A signal that it might be prioritizing employment over strict inflation control. That's reminiscent of the stop-go policies of the 1970s, which didn't end well. This perceived shift, well, it quickly erodes investor confidence in the Fed's commitment to price stability. And that can destabilize long-term inflation expectations, which is bad news. Higher inflation expectations and policy uncertainty. They directly increase that term, premium investors' demand. They want more compensation for the added risk. So, the perverse result, and this is key, A 50 basis point rate cut could trigger a larger increase in that term premium than the fall in short-term rate expectations. This leads to a net rise in long-term rates rather than a fall. And we actually observed this phenomenon, according to the sources, in the second half of 2024. Long-term rates kept climbing despite the Fed starting cuts.
Wow, okay. So the key insight here is that while a rate cut might look like a green light, it's actually potentially a red flag in this context, signaling a potential policy misstep that just inflates risk premiums. That's a significant reframing of conventional wisdom for investors, definitely. Now, let's pivot a bit from the rate cut narrative and focus on the sheer mind-boggling scale of U.S. government debt. The numbers are truly eye-popping. Total national debt around $37.4 trillion in September 2025, and debt held by the public is roughly 100% of GDP. That's a level, as you said, historically seen only after major wars.
Right. And to put this in context, these aren't just large numbers. They reveal, as our sources argue, a fundamental structural mismatch in the U.S. economy. The Nonpartisan Congressional Budget Office, the CBO, paints a pretty grim picture. Debt held by the public is forecast to reach a record 107% of GDP by 2028, then 118% by 2035, and an astonishing 156% by 2055. These figures far exceed the post-World War II peak of 106% of GDP. This isn't a temporary problem you can just fix with a few policy tweaks. It's deeply structural. It's baked in almost.
And what's driving this relentless increase? I mean, where is it all coming from? Our sources point to a structural deficit that's just, well, unsustainable seems like the right word. The federal deficit for fiscal year 2025 is expected to be $1.9 trillion. That's about 6.2% of GDP, like double the historical average. The primary culprits are mandatory spending programs, Social Security, Medicare, we know those. But critically, the soaring net interest costs on the debt itself, they've now surpassed defense spending to become the government's third largest expenditure. That's an incredible, almost unbelievable shift in priorities, isn't it?
It is. And this fiscal reality translates directly into what our sources call a tsunami of supply in Treasury bonds. It's a flood. The Treasury is expected to borrow over $1 trillion in just the third quarter of 2025 alone. Think about that. One quarter? And total annual issuance is projected to exceed $19 trillion. Primary dealers, the big banks trading this stuff, they anticipate annual deficits to continue above $2 trillion for the foreseeable future. This unprecedented and sustained volume of new supply fundamentally alters the supply-demand balance in the bond market. There's just so much more debt needed to be absorbed month after month, year after year.
This tsunami of debt brings up a term I encountered in our sources that really stood out: fiscal dominance. From what I understand, it suggests a risk where the central bank's policy choices get tangled up with the government's borrowing needs, maybe even forcing them to keep rates artificially low just to manage those huge interest payments. Is that the essence of it? And if so, what are the implications for you, the listener, the investor?
You've got the essence perfectly. And the implications are, frankly, severe. Such a perception, even just the perception, could lead to a collapse in Fed credibility, and potentially a flight of capital from both the currency and treasuries, people just losing faith. Moreover, the buyer base for U.S. debt is weakening significantly. This is another key point. Traditionally, this debt was absorbed by domestic investors, foreign central banks, and the Fed itself through quantitative easing, or QE. But now the Fed is engaged in quantitative tightening, QT. It's a net seller, removing a key source of demand. Major foreign holders like Japan and China, they face their own economic pressures, geopolitical considerations, making their continued large-scale purchases uncertain. Plus, there's a growing desire for diversification away from the dollar. So the result is that price-sensitive private investors become the marginal buyers. They're the ones left to pick up the slack. And to get them to absorb this historic volume of new issuance, the Treasury must offer higher yields. It's basic supply and demand. This acts as a kind of multiplier effect on supply pressure, creating a structural headwind for long-term rates.
A headwind that a mere 50 basis point Fed cut simply cannot reverse. It's just too big.
Okay, so we have this unprecedented debt situation, a changing buyer landscape, and a Fed potentially caught between that rock and a hard place. Now let's turn to another critical piece of this puzzle, the inflation riddle. Inflation remains stubbornly high despite these clear signs of economic slowdown we talked about. The August 2025 CPI report showed headline inflation at 2.9% year over year. Still high, but maybe even more critically, core CPI, which excludes volatile food and energy prices, was even higher at 3.1%. And the Fed's preferred measure, core PCE, also came in at 2.9%. All of these are significantly above the Fed's 2% target. It just won't go down easily.
Exactly. And our sources unpack the sources of this stubborn inflation quite well. A major contributor is sticky service inflation. This is driven by things like wages and contracts, which are slow to adjust downwards. Housing costs, for instance, up 3.6% annually, medical services up 4.2%. These are big components. And on top of this, we're seeing new inflationary pressures from tariffs, leading to rising goods prices again. This represents a negative supply shock, which is inherently difficult for monetary policy alone to address effectively. It's not demand-driven inflation that the Fed can easily squash. It's more of a cost-push inflation, harder to fight.
And this persistent inflation is happening while the labor market is sending what our sources call a false signal, a signal that seems to justify those rate cuts we just talked about. We already mentioned the weak August 2025 jobs report, only 22,000 new jobs. So what's the deeper story here beyond just one slow month in the job market? What else is going on?
Right, there's more to it. The really alarming detail revealed by the Bureau of Labor Statistics, the BLS, is a preliminary benchmark revision, and it showed 911,000 fewer jobs were created over the preceding year than they initially reported. Let that sink in. 911,000 fewer jobs. This is the largest downward revision ever, indicating the economy was significantly weaker for a longer period than previously understood. And unemployment has now ticked up to 4.3%. It means that the slowdown isn't just recent. It's much more entrenched than we thought.
So you've got a weak labor market, that's your stagnation, coupled with persistent above-target inflation. That combination sounds eerily familiar, doesn't it? It's exactly what our sources describe as the stagflation trap that the Fed now finds itself in. It's a truly unenviable position. No easy answers.
Precisely. The Fed is in an almost impossible dilemma, easing monetary policy to support growth risks, reigniting inflation, but tightening further to curb inflation risks, triggering a severe recession. This exact policy quandary, this tightrope walk, was a defining feature of the 1970s economic crisis. And for bond investors, this environment points towards what the sources call the inevitable erosion of real returns.
The phrase inevitable erosion of real returns, it sounds pretty dire. Can you maybe walk us through what that actually means for someone holding bonds, in concrete terms, put some numbers on it?
Certainly. Let's look at a calculation based on the sources. Say a 10-year Treasury yields 4.25%. And let's say core inflation is running at 3.1%, as it was recently. The real return, your return after inflation, is a mere 1.12%. And that's before taxes. It's like, as you suggested, filling up your tank and realizing a chunk just evaporated. Your purchasing power is barely growing. Now, consider the risk highlighted. If Fed easing does reaccelerate inflation, maybe back up to 4.0%, that real return plummets to just 0.25%, basically zero. And worse, if long-term rates also rise, say to 5.0%, to compensate for these renewed inflation risks. Investors then face both significant capital losses on their bond holdings and this erosion of purchasing power. A double whammy. In this kind of scenario, long-term bonds offer no protection. They actually become a liability.
It's clear that the present moment has some unique and pretty serious challenges. But sometimes history can offer invaluable lessons, right, if we're willing to look closely. Let's turn to a crucial case study mentioned in the sources, the Great Inflation of the 1970s. What can we learn there?
Well, the 1970s were characterized by significant policy errors, looking back. The Fed, operating under political pressure and, frankly, a flawed understanding of the Phillips curve at the time. They repeatedly eased monetary policy prematurely whenever unemployment ticked up. This happened even amidst severe supply shocks, like the OPEC oil embargoes. This stop-go policy, easing then tightening then easing again, it utterly failed to control inflation. And ultimately, it worsened both inflation and unemployment. It created a vicious cycle of instability.
Right, and the critical lesson for bond investors from that era, which our sources hammer home, is that long-term rates did not just blindly follow the Fed's policy rate down.
No.
Not at all. Instead, as the Fed's credibility eroded and inflation expectations became unanchored, investors demanded a much higher inflation premium. This caused 10-year Treasury yields to surge, eventually past 15% by 1981. 15%, inflicting massive real losses on bondholders, even while the Fed was attempting to ease policy at various points. So while the Fed might have been cutting, the market was demanding much higher returns because of inflation fear.
Exactly. And this is where we need to connect the past to the present carefully. While the absolute levels of inflation and interest rates in the 1970s were higher, yes. A comparison table in our sources shows some striking parallels in the dynamics between roughly 1973, 1979 and 2023, 2025. We see similar patterns. Above target inflation, rising unemployment, and a Fed grappling with this difficult policy dilemma. For example, average headline CPI was about 8.7% then versus 3.1% now. Okay, different levels, but core CPI was 8.1% versus 3.8% now. Unemployment, 6.6% versus 4.3%. 10-year Treasuries averaged 7.8% then versus 4.2% recently. The shape of the problem has echoes.
Okay, so we're seeing echoes of the 70s in the economic dynamics, the policy struggles. But here's the crucial difference, the really scary part, which makes today potentially even more precarious. The debt. The U.S. entered the 1970s with a relatively low debt-to-GDP ratio, around 25.1%. That gave policymakers much more flexibility, more room to maneuver. Today, the Fed faces 1970-style problems: the stagflation risk, the policy dilemma on top of post-World War II levels of massive debt. Currently sitting around, 121.5% of GDP held by the public? That's a fundamentally different and much weaker starting line.
Exactly right. And this unique combination of high debt and 1970s-style problems makes the current situation, according to our sources, potentially far more dangerous for bond investors, because it combines the risks of fiscal dominance, the debt-overwhelming policy, with the risks of monetary policy failure, like we saw in the 70s. Now, another historical period often cited, sometimes misleadingly, by those who believe high debt is manageable, is the post-World War II debt experience.
Yes, I've heard that argument. It often goes something like the U.S. successfully reduced its debt-to-GDP ratio from over 106% in 1946 down to just 23% by 1974, so why can't we just do it again? What do our sources say about using that period as a guide?
Well, our sources effectively debunk this myth, arguing it's a poor comparison. They explain that the successful debt reduction after WWII was achieved through a specific set of factors entirely absent today. First, there was financial repression, a very deliberate policy. The Fed artificially fixed interest rates at very low levels until the 1951 Treasury Fed Accord. This ensured government borrowing costs were kept well below the rates of inflation and economic growth. It effectively transferred wealth from bondholders who earned negative real returns to the government. It wasn't painless for investors. Second, the U.S. ran primary surpluses, meaning tax revenues exceeded non-interest spending for most of this period. They were actively paying down debt. Compare that to today's massive primary fiscal deficits. We're adding debt, not subtracting. And third, the post-war era experienced truly exceptional growth, driven by a unique demographic boom, the baby boomers, and a massive productivity surge. That kind of growth spurt is simply not reproducible today. The CBO projects long-term real GDP growth around just 1.8%, far, far below those post-war averages.
So, putting it all together, the post-WWII experience actually serves more as a warning about the extraordinary and often painful for investors measures required to resolve massive debt problems, rather than a reassuring guide for managing current debt levels easily. It highlights what it actually takes to get debt under control, and those conditions just aren't present today. Not even close. Okay, let's try to bring this all together now. We've explored the unprecedented fiscal supply, the sort of tsunami of bonds. We've looked at the persistent stagflationary pressures, sticky inflation plus slowing growth, and we've examined the potential for Fed policy errors, illuminated by some worrying historical parallels. These three factors acting together seem to create a structurally bearish environment for U.S. long-term treasuries. The upward pressure on the term premium from all these structural issues seems highly likely to overwhelm any cyclical relief we might get from near-term Fed rate cuts.
That's right. A 50 basis point rate cut, or even more, shouldn't be seen as that automatic green light for bond investors anymore. Our sources describe it more as a potential bull trap, a tactical short-term response to cyclical weakness that could actually worsen the strategic long-term outlook by exacerbating inflation fears and further expanding that crucial term premium. The real danger here, as highlighted, is that this could trigger a steepening of the yield curve in a bad way, where short-term rates fall because the Fed cuts, but long-term rates actually rise due to inflation and fiscal risks. That leaves long-term bondholders in a very precarious position.
Okay, so given everything we've discussed, this deep dive into the source material points to some pretty clear strategic recommendations for you, the listener. First, avoid duration, or at least be very cautious. This means significantly reducing or maybe entirely avoiding long-duration U.S. Treasuries, like the 10-year and especially the 30-year bonds. The risk of capital loss from potentially rising rates likely outweighs any price appreciation potential in this environment. Second, if you need Treasury exposure, prefer short-term runs. Focus on the short end of the yield curve T-bills, maybe notes with maturities of 2 years or less. This allows you to secure the current high short-term rates while minimizing that interest rate risk and also reinvestment risk in what looks like a volatile period ahead. Third, it really seems time to reevaluate the bond's traditional role in a portfolio. Long-term treasuries might no longer serve as that reliable hedge against equity declines. We saw this fail in the 1970s, and we saw it fail again in 2022 when both stocks and bonds fell sharply together because of inflation. So you might need to seek alternative diversifiers for your portfolio, things that behave differently. And finally, number 4, focus on real returns. This seems paramount. The core goal for bond investors, perhaps all investors, should be achieving positive real returns after inflation. This means considering options like US Treasury, inflation-protected securities, maybe high-quality corporate bonds if they offer sufficient credit spreads, and potentially other real assets that offer some protection against inflation's bite.
And building on that, this raises an important, maybe fundamental question for everyone listening. If the very bedrock of safety in finance, the U.S. long-term Treasury bond, is undergoing such a profound transformation, what does this fundamentally mean for how we perceive portfolio diversification? And what does it mean for the future of truly safe assets in a world grappling with these powerful structural forces? It really forces us to rethink what safe actually means going forward.
A very important question, and definitely one well worth exploring further on your own. It challenges a core tenet of modern finance, for sure.